Let's talk about something in the mutual fund space. And if you've watched the equity markets with a certain amount of attention over the course of the last couple of weeks, you will have noticed that there's been a sharp drop in IT stocks. And this is because one after another, there has been a challenge that has been posed by artificial intelligence. And of course, the big conversation was the Anthropic plugin and the fact that quite a few of the IT services companies were faced with the idea that maybe some of the work that they're doing would be redundant heading into the future. And that is having a bearing on this index. So if you've got an investment in the IT space, then you will have seen sharp cashes in your portfolio. How do you deal with that? And you've been sitting on the sidelines, are you thinking this might just be a good moment to invest? Well, Rushabh Desai is joining me to tell you what you need to do in this kind of a situation. Rushabh, thanks so much for taking the time. And let me start by asking you what you made of the index and the way that it's declined, the fact that it's worse than COVID-19 at this point.
Hi, Alex, thanks so much for having me on the show. You summarized it quite well. See, the Nifty IT index has fallen around negative 27% as on 13th of February 2026. Okay, now this is a very steep decline from its all-time high, which was in around December of 2024. Second point is that the fall is basically based on the AI technology, which is rapidly coming up into practical use, and which is considered as a threat to the traditional IT service industry in India. Now, if you observe that around 18.3 billion rupees worth of FI's money has gone out of the IT sector, and market sentiments are kind of like quite weak at this point of time. So I feel recovery will take some time, till the time Indian IT companies show a strong roadmap, how they would adopt AI in their day-to-day technology in their day-to-day lives.
We'll talk about the various sector funds and thematic funds that have IT and how they've performed over the last year, and we'll juxtapose that over the last 5 to 7 to 10 years as well, Rushabh. But before we get to that, let's talk about the outlook, because you have two schools of thought. Already a lot of fund managers have been underweight on IT because they've said that the growth rates just aren't there. And at that time, the argument was that the valuations absolutely don't support this. But you've seen valuations come off quite dramatically. And, there have been certain arguments, without getting too technical, to say that maybe there's room for a little bit more correction, but then it becomes incredibly attractive. What does the outlook look like according to you?
Alex, see, first of all, the Indian IT sector is not going to die. Let's beat the fact, okay? Technological, challenges and global technological fears have persisted in the past, and I think we are going to survive. It's just a matter of some time. Now, if you see the giant IT companies, which are the large cap companies, they are sitting on huge pile of cash. Okay, so they will definitely take steps in line with the global technological changes to protect their revenue growth. Now, I feel that the large giant companies may take some time to adopt to AI, because of course they have systems in place. They will have to make some dramatical changes. But I feel that the mid and small IT companies would adopt much more quicker. Now, the fund managers which were talking about the earnings, they were predominantly talking about the large cap earnings. The large cap earnings have been good, but they haven't been quite robust in double digit as what it was expected. But on the other hand, the mid and small cap IT companies have done phenomenally well. So their revenue growth, their PAT growth has been in superior double digit. That's what I have observed from the data. Now, if you talk about the valuations, Alex, yes, the valuations have been very attractive. See, as on 31st of January, the Indian IT index is trading at 22 times, which is close to its long-term average at 21.6. Okay. Now, with the sharp fall in February 2026, the valuations would have become very attractive and would have been lower than the 10-year average. So I feel that this is a a right time to gradually invest. I wouldn't go all in one at this point of time, but at least like 50% of, say, like if someone has 100 rupees, so probably fifty rupees I would deploy right now, and another 50 I would stagger it over a couple of months, Alex.
And we'll talk about how to do this as well. But it's very interesting. You're talking about how at the end of January, it was trading at its long period average on price to earnings. And it has fallen so dramatically over the last couple of weeks, right? If you think about it, last week at the index level, the Nifty IT dropped over 8%. And the week before that, it dropped 5%. So that's how quickly things can turn in the capital markets. And you should be willing and able. Why don't you spend a little time, Rushabh, just describing this as one of the biggest threats of having a concentrated portfolio, a sectoral or thematic fund?
See, Alex, usually sectorial and thematic funds are not meant for retail investors. Now, the reason is that the sectors can be very volatile and very cyclical. Now, if you just look at this drawdown, has been 27% negative. Now, similar drawdowns have been witnessed in the past. Say, in 2008, the Nifty IT index fell by 55%. Okay, and in 2020, the Nifty IT index fell by minus 33%. So number one, it's not meant for all investors. It's not meant for all retail investors. It's predominantly meant for investors who understand the capital markets, who understand the sector at the basic level, and plus who have surplus money to play around and can take some tactical bets, because the entry and exit is absolutely important in sectors, Alex.
Let's talk about the risk and return specifically of the IT index, right? You mentioned a couple of years when drawdowns have taken place. A few of those stand out. The Y2K moment, right? 2000 was when the dot-com bubble burst. You had 2008 financial crisis. You had 2020 COVID-19. 2022 there was geopolitics, and then now you have AI. But how has this sector performed, and what is the kind of risk reward as things stand right now?
Alex, this is a very good question what you have raised. See, the overall IT index has been a consistent performer on a 5-year daily rolling returns basis. Now, I pulled out the data from 2004 till 2026, okay, which is more than 20 years of data. So the average return on a 5-year daily rolling returns basis has been 15.5% CAGR, which is phenomenal, number one. Number two is that the index since 2004 has delivered greater than equal to 12% compounding returns 70% of the time period. I'm talking about since 2004. So 70% of the time period since 2004, the index has generated greater than equal to 12%. So the overall returns on a 5-year daily rolling basis has been quite consistent. There has been cyclicality and volatility in short to medium term. So I would suggest if someone wants to take some kind of tactical bet, at least keep a 5-year minimum time horizon in mind, even from these levels.
Yeah, that's a fair point. And in the time frame that you've identified, it's very interesting that the IT index has given maximum returns of 40%, minimum returns of minus 21%. So you have to be willing and able to take the kind of hit and knock that has been witnessed over the last couple of weeks, because the timing is very, very important, as you've pointed out, Rushabh, in the sectoral thematic space. So with that in mind, from an overall portfolio perspective, what is the kind of allocation that is appropriate? And in this case, if somebody had allocation, it's dropped dramatically. So where should it be?
So if someone has an allocation which has dropped dramatically, just wait for some time. I wouldn't take any hasty decision at this point of time of getting out in the sector. If someone has some kind of cash tactical surplus cash who can take kind of a tactical bet, then probably say 5 to 7% of the overall portfolio can be given to the IT sector, but I wouldn't go beyond 7%. Anywhere between 5 to 7% is a decent bet in the IT sector. See, companies may rise and fall, Alex, okay, but the index will always remain constant. The index is not going to go bust, right? So even if there are certain companies who go bust in the IT index, the IT sector will have replacements in some way or the other. So I wouldn't go too dramatic and buy individual stocks at this point of time. I would rather bet on an active mutual fund or an passive mutual fund, just from a better risk return point of view.
Yeah, fair point. Bear in mind, however, that further drawdowns are not out of the question. You could have more pressure on the downside, and there's quite a bit that is playing out in the space. The world as we know it is changing. Rushabh, thanks so much for taking the time. Pleasure speaking with you as always.
Thank you so much, Alex.
All right, with that brings us to the end of this edition of Your Money Matters. It's been an absolute pleasure bringing it to you. Let us know the subjects that you'd like to listen to or hear about, and we'll pick them up. Stay tuned. This is NDTV Profit.